Hello and welcome to another episode of Purple Ventures Zoom video podcast. My dear guest today is Radek Jezbera, CEO and co-founder of Kilde, a Singapore-based startup, an investment platform which allows investors to invest into alternative assets such as buy now, pay later, small and mid-sized enterprises. Dear Radek, may you please introduce yourself to the audience?
I'm Radek. I am from the Czech Republic as well as you, right? We met each other at one of our past workplaces at a company called Deloitte. And I could tell about myself, I'm kind of self-made financial professional who's trying to stay curious, trying new things, right? And after, I would say, a moderately successful corporate career, 5 years ago, I have embarked on the entrepreneurship journey in the area which I think I know the best, which is consumer and SME credit and enablement of the underpowered, I would say, unprivileged people in the emerging markets. And that's why we have started an investment platform in Singapore, basically focusing on the Southeast Asia.
Radku, what is your definition of a startup?
It's the similar definition as a project. I used to be a project manager, including the IT project manager. It's something which is new, hasn't been done before, right? Like as a project, so it doesn't follow the kind of common recipes, right, in a way, and it doesn't have a kind of like a expected outcome. If I do this, I will get this, right? Maybe I will get this, but maybe I will get this or something else. So that's something which hasn't been done, where you need to find your own way how to achieve. And I would add like a one distinction, that should be something which should scale and should potentially become like a big business, right?
So you mentioned 5 years ago that you basically left the corporate world and started the entrepreneur world. What was your journey to get to that point? And what you think was the trigger that you 5 years ago you woke up and said, enough, let's do something on my own?
I think as most of the entrepreneurs, it was the kind of the circumstances, right? Because it was in back of my mind that I would like to do something on my own. I had a lot of kind of ideation sessions with my friends, what we could do and so on. And then eventually I arrived to the time of my life when I could finish my corporate contract, right, without breaking any obligations, right? And I say, okay, now's the time. Let's do something on my own. And my first business was a credit risk consultancy business, which I did with my friends from my previous jobs. And I was doing it for a while. Actually, we grew it to a formidable business with $1 million revenue with 5 employees. So it was a nice business. But it was still, I wouldn't call it a startup, because although it had kind of this, you need to find your own way, but still it was a kind of classical kind of service business with nice margins, right? With a bit of a prestige, you may say, but not a startup business, right? And the real startup business, I have embarked on this journey 2 years ago, and this is much wilder ride than anything I've tried before.
Yeah, you. Besides the corporate experience, you also have an excellent MBA, right? You did that some years ago in the middle of your career, let's say, the excellent executive MBA. Looking back, would that prepare you for the startup journey, or it's more designed pretty much for the corporate career?
Okay, I did my MBA 10 years ago, right? So it was a probably different MBA than you can get nowadays, because these schools are changing. And it was IE Business School, and I did it in Madrid. I would say like generally probably no, because at the time there were like courses like design like for entrepreneurship, but it was kind of like kind of old school entrepreneurship. They kind of taught you write a business plan and do a financial model on the business plan and plan everything and many years ahead, and then you execute the business plan. This is not how startup business kind of like a work, right? But at the same time, what was great at the school was the people there. And one specific course, right, was really like helpful to me. It was about internet business, and the course was just about, it was 10 sessions where they invited like different entrepreneurs coming to the class, and they were talking about their business, how they start a business, how did they come up with the idea, like which challenges they face, and so on. And it was just super interesting, and it kind of like really motivated me towards like that entrepreneurship kind of journey. And I was amazed like by the fact how much you can actually achieve in a quite like a short period of time in a startup if you are doing it well, and if your timing is well and team around you well, then in a 9-12 months you can build incredible things. And I was thinking, okay, I did like a 12 months project in the enterprise, very successful ones, but somehow I was still a salaried employee, right? So after the end of the project, I was at the same position where I started, right? Versus the entrepreneurs, they could have the benefits, right? What they have been building. And I was thinking, okay, am I actually investing a less amount of time, less amount of passion, less amount of energy? Do I have a less amount of skills? Like probably no, right? Those people are the same as me. They just had the courage to do like something, right, which is more risky.
Prior, starting Kilde, or in that period, 5 years ago, you also tried investing, right, yourself into the startups or startup. What was your lessons learned from that?
You need to have a lot of money to be investing in a startup. If you just investing like from your like a personal savings, that probably you will not achieve the kind of diversification like you need, right? So yeah, that's lesson learned number one. But lesson learned number two is good, like to observe the journey. Like I had both successful and less successful kind of investments with the people I know very well, and then you kind of see, right, the dynamic like in the team, right, the challenges kind of they face. It's kind of like education money, right, that you invest into startup in a way. And sometimes what I also learned, like when you kind of believe, like from outside, that they are not like doing as good as they could, like given certain like choices, you would like to like help them, but being an investor, you don't have, a minority investor as myself, you don't have that much leverage, right, over that. So sometimes it's a bit frustrating, right, to be watching like on the sidelines.
You were basically a business angel, right?
Yeah, like an angel, right? Yeah, and that's what I try to kind of do better in Kilde, to communicate better with the investors we have, because we have not so many investors. So I want to keep the investor base small, right, in terms of number of counterparties. And we try to really select like people who can help, people and companies who can help the business. And we really try to listen what they say. I'm not like saying that we always like do what the advice you get, because I heard it from one of the entrepreneurs. They say that the best advice you can get is to listen to advice, understand very well the assumptions from which the advice is given, and then do your own thing. That's the safest way actually to do.
Yeah, because the one giving the advice may have different assumptions than you do, right?
Yes,
or
yes.
This definitely is not there with you 24 hours, right, a day. So
yes, correct. But still, the advice might be that the person from outside sees something which you don't see, right? And it is actually very interesting that the person is coming from a different assumption, right? So it's important to understand the advice, right? And sometimes you take it, sometimes you do something else, sometimes you modify it, right? But it's your decision, right? It's the entrepreneurs, the founding team is the one which have the highest stakes in it. So they need to make the decisions.
Radek, what is, if you were to explain it to your grandma, what is Kilde doing?
Oh, it's if I would explain it to my grandma, I would say it was something like a saving account, but just with the difference on a saving account, actually you can make more money than inflation is doing. If I were to be investing, if I would be explaining to like someone a bit more financially savvy, then I would say this is an opportunity to discover and invest into an income opportunities, like a true income investments, which will give you a regular monthly or quarterly returns. These returns will be above inflation because our returns are between 7 to 11% per annum, and they will be pretty safe, right? Still, obviously, there is a certain risk involved, and the risk is higher than with savings account, right? But given that we are a responsible, I would say, guardian of that funds, and we think that understand that those investments where we are placing the money, I would say it's a pretty safe, and it's very unfortunate that these kind of investments are not available for most of the people, right? It's usually available only for the wealthy investors, institutional investors, right? Which understand them, which are like more eager to invest, but like common investors, maybe like a two of us even, for them it's very hard to reach, right? And very hard to kind of make something like from your money.
Can you explain more for the audience that what are the two parties you're connecting together as a Kilde, and what is your added value on top of it?
Of course. So going to even a deeper level, right? So we are an investment platform, right? And it's a two-sided platform. So basically you can imagine it something like Amazon, like a shop, right? And that Amazon has a certain goods to sell. So what we sell credit securities, credit like notes, right? Which we have helped to create from consumer lending or SME lending assets. So that part is a bit complicated, but the investor don't need to worry about it. So it's a highly diversified, relatively safe investment securities. And investors just pick the ones which they like, as they would be shopping in Amazon, right? So we are a marketplace in a sense, like in an Amazon. They can choose geographies like Asia, right, where most of the investment coming. We have a few European ones as well. Type of assets, right? ESG assets, which means sustainably like sourced investments, right? Or pure for-profit assets as well. SME lending, consumer lending. So those different kind of securities, and they can create their own portfolio, or they can turn on the autopilot on our platform to create the portfolio for themselves and just like enjoy the coupons, and that's pretty much like that, like an Amazon, right, for investments, supermarket for investments.
So again, just to make it simpler for the audience, so that those companies basically who provide those unprivileged people basically financing consumer loans that they need to buy I don't know, moped, for example.
Yeah, motorbike, right?
Motorbike or TV, because there's like 2 billion people on the planet who do not have access to bank financing,
yes,
bank loans, right?
Yeah.
Or bank services even. Right, so there's these alternative lenders,
yeah,
right? And so they are on one end who are using your services, right? They basically seek financing, right?
Correct. So basically, if you go back to the history, which I will make it short. In 2008, right, there was a lot of new rules imposed on the banks, which they basically told them they need to create much more provisions, right, for their loans they are actually giving to the people. And the banks started to be even more reluctant than before to give loans to people, right, and to the businesses. So SMEs were like problem always, right? But even the consumers which don't have a long credit history, right, or is their first-time loans, it is increasingly like difficult for them to get a loan. And from the bank perspective, I also understand their reluctance, because suddenly, because of this regulation, it became very expensive for the banks to issue these loans. So they kind of withdrew from this market completely, right? But the need of the consumers and SMEs was still there, right? There's still the financing gap, like which they need to buy a washing machine, right? They need to buy a fridge, right? They need to buy, if you want to be a food delivery driver, you want to buy the electric bike, right? To drive it, right? Or you need to buy a mobile phone, right? Because a mobile phone give you access to a lot of services. So people need financing. And who step in where so-called these alternative lenders, we can call it multi-finance companies, they are called differently in the different markets, and they basically, the premise is that they use technology and data to be able to evaluate and service those customers, and they do it cheaper than the banks, right? And they are not that constrained on the capital side, right, by the regulation, so they can give them the loans and a sustainable price. Also, there are certain players which are, I would say, it was a problem in the past. There were some players which were less ethical than we would like, right? So to see different payday lending, these kind of products which prove to be damaging to the customers. Nowadays, the industry in general evolve into a more sustainable model, and it also was helped by the regulation. The regulators didn't impose the same kind of regulation on the banks, but at least they set the rules, right, for them, right? So they couldn't charge more than the certain interest, right? They are supposed to report, right, on the loans they actually supposed to report to the credit bureaus, which again is helping the customers to build their credit history, right, and eventually take a loan from the bank, right, or take mortgage, for instance, these kind of loans. So these lenders are proliferating, specifically in Asia and in Southeast Asia, and they became systemic players in the financial ecosystem, and very important players which help SMEs and consumers to access credit.
Now, when you are your added value, right? Big one is that you due diligence and you deep dive into the books of these alternative lenders and say, from our perspective, this is a healthy book, and if there's a healthy ratio or how much money they are actually need, then that's your added value. The question is, how much of an artificial intelligence now or in the future versus human judgment you're using when you're looking at the books?
Okay. So the lenders themselves, they use a lot of machine learning, right, and stuff, because they might have a lot of data points on each individual person. That's how they are able actually to extend the credit, prevent the fraud, right, from happening. We use also a certain level of machine learning, but our task is a little bit easier in a sense, because we look at the loans they have issued, right, and we look at the performance of these loans they have issued, and we look how sustainable the business is in terms of the lending, and then we also look at the financial books, right? How much cost they have, right? How much gross margin they create, when they're gonna break even if they haven't yet, right? Breaking even, how much provision they create for the loans. So we look at all these things, which might be difficult to evaluate for even for an institutional investor, right? That would be something not so common like a knowledge, right? You need to be insider in the industry to understand these things. So we believe that we understand this very well. also because our team is came from the industry. I used to work for a long time for a company called Home Credit, which was one of the pioneers in the space. And we create this kind of information bridge, right, which is the assurance for the investors that we know what we are doing when we give debt capital, right, to those companies, right. And again, because we are also a regulated dealer in securities and regulated financial advisor, we can craft very simple investment instruments, which are then very understandable even to the grandma, right? Because okay, you invest into something and that gives you 8% per annum, right? And there's going to be every third month you will get something from it, right? And that's it. So it's a lot of complexity, but like the experience, like for the investor, must be seamless and very understandable, very safe, and very transparent.
You're talking about the industry expertise. So where did the idea to start this particular business startup came from?
So I didn't come up with the idea. I'm more like an execution person than the idea person. So my co-founder Oleg came up with this idea, basically seeing in his own eyes and as a shareholder of one of these consumer lending companies in Europe, he was thinking like, what is like the biggest problem those companies are facing, right? And we really like draw the whole value chain from the issuance of the loans to the end consumers, right? Sourcing the potential borrowers, right? To machine learning, artificial intelligence, right? Running a lending and collection business to the actually capital kind of rising, right? And we found out that systematically there are very few like people and companies doing a capital raising, right, for these alternative lending firms. And then later on I realized, okay, most of like the bigger ones have maybe one person who specializes in liaising with the investors using the personal network, right? But then all these companies have the same needs, right? And we thought, okay, if we build a platform, right, like the supermarket, like the Amazon marketplace, where a lot of these lending companies would come together, right, put their capital needs, right, they're on the table, then a lot of investors would come, right, also on the side and start buying it, right? So we can connect very nicely those two parties, and that's what we thought that would be a great idea. And based on the like initial reaction like of the market after 1 year being in operation, it seems that this is something which is needed at the market. It will still take a bit of a while to grow like into the kind of volume we want, right? But I believe that this is something very needed and something which is welcome by everybody.
How you are unique in the startup scene in a way that this type of business was impossible to do without getting a proper license, right, from in this case a Singapore regulator, and you did manage to get it in a pretty an exceptional fast pace, right? How did you manage to do that?
I think we've been a little bit like standing on the shoulders of the giants of some of the investment platforms which came before, right? And they were kind of educating the regulator, right, about private assets, right, and how to offer the private assets to the investors in Singapore. But I think the regulator was convinced by the strength of the team and by the experience like of the team, of our like credentials before. And I think we also laid out very clearly like the whole business model, what we intend to do, that we intend to work only with regulated companies on the side of our borrowers, right? And that we intend to work in the beginning with the accredited investors and institutional investors. So they felt probably there's not so much risk for the financial system, right, in Singapore, doing so. And Singapore being basically one of the financial centers in Asia, Also, the regulator wants innovative companies with new ideas which are based on technology coming in, right, and bring the fame and reputation of the Singapore, right, abroad. So I think that was why we got it in a quite short time, in 5 months actually from the application, we had the license.
How much within those 2 years is reality of the business pushing you to change the business model actually? How much it seems the reality, what will work business-wise, is different to what you expected with the initial idea and with what you actually even proposed to the regulator?
Interesting question. It's always like kind of tempting to pivot like to something, because you see a lot of like opportunities, like let's do that, we could do that. So it needs to be like a healthy balance between your focus, right, and ability and willingness to pivot when you really like a need to pivot, and when it makes sense to pivot. And I don't think we have pivoted in my definition of the pivot. My definition of pivot is that when you start solving a different problem. Because you always adjust, right? If you still work with the same problem, and in our case the problem statement is that on the one hand we want to bring liquidity to the consumer and SME lending companies, right? And on the other hand we want to bring income investments, right? Sustainable income investments to investors. So as long as we are solving these like two conjunctive problems, right, then we are doing the same thing. But how you're going to achieve it, and you need to change every day almost, right? Almost every day you need to like navigate, and the opportunities sometimes present yourselves, and the reality has a different color than you thought, right? Usually it's much harder. Usually things are twice or 3 times much more harder than we thought they would be. But it's something you need to face.
You as a team are very, like, considering that you're less than a dozen of people, right? You're very, very geographically distributed. Europe, Singapore, Dubai, or sorry, Abu Dhabi. How does that work? How did you find that challenging, basically?
I think during the COVID time it was paradoxically like less challenging because nobody could travel, right? So the playing field kind of leveled. But because we built a company like that, like from the beginning, we kind of have chosen the tools and the rhythm of work which is conducive for like working across time zones and across like territories. So like nowadays it's I would say easy, right, with the Zooms and collaboration tools, right, that you can write documents together. Kind of we almost don't have any paper-based like documents. Like in the company we sign documents digitally. Not such a big deal, and you can make it work to your advantage as well, right? If you are like aware of the time zones properly, then you can prepare something and hand over to your colleagues which wake up earlier than you, right? Then you wake up and you can discuss what they did, so it can work to your advantage as well.
You are facing, like any startup who is starting a marketplace or a platform, right? You need to have the buy side and sell side, right? You need the demand side and the one who's offering the services, right? There's this chicken and egg problem, right? What's first, right? Do I need to have the portfolio of alternative lenders, right? Or do I need to have investment first? How complex this problem is?
Yeah, it's a good question. Actually, it's a very kind of not so well researched kind of problem. Just only like recently, there's an excellent book from Andrew Chen about like a network businesses, right, and about this chicken and egg problem with the platform. So basically, the answer is that you need to understand which side of your platform is so-called the hard side, the one which is like in limited capacity, harder to get, right? And in our case, those are the deals, right? Those consumer lenders, SME lenders, right? Because it takes time to establish the relationship, right? Prepare all the paperwork for the investments, agree on the pricing or everything, right? So this is our hard side. And then we have the other side, which are the investors, like with the liquidity. And I always like thought about the liquidity, which is like not true, but I thought about it. Potentially the liquidity is infinite, right? From our perspective, right? Because the ocean is so large and we are in a small ship, right? So we don't need to like worry that much. If we have something attractive to sell, right, then we will find a buyer for that. And actually, one of the advisors like put an example of a Uber taxis, right? It's a good example, like which side is the one which you need to build first, right? And it becomes very obvious. First, you need to have the cars and drivers, right? If you don't have the cars and drivers, you can be only convincing customers, oh, maybe like one day I will have a car, and maybe you can take it like to work or to a date or something. Well, how effective it's going to be, right? It's not going to be very productive conversation, right? But when you have the drivers, right, and they have this particular concentration in that area, and within a 10 minutes time you can get a car, then it's a different kind of conversation, right? Then you talk, okay, how much, right? How fast, right? How safe it is? How can I pay? How convenient it is, right? So that's the same, right? We need to have the deals, and we focus on the deals, and we almost work like for the first 12 months, we work on building a pipeline of deals, right? So have a solid pipeline of deals, the best companies in the Southeast Asia region. And then once we had it, we started approaching the investors.
And if you look at the 2 years journey, what was like the toughest moments? What was the difficult lessons learned?
There were many tough moments, and I guess many more tough moments ahead of us. Always like difficult when you feel that when you start doubting like yourself does it make sense, like what we are doing, right? And they are like many times gives you the circumstances give you opportunity to start doubting, right? The whole idea, and you are kind of susceptible in that moment, like prematurely pivot into something else, right? Or go after an easy money, right? For instance, like in our case would be doing consulting services in consumer credit, in a portfolio analytics, right? We could have a nice lifestyle business, right? From this relatively easily, right? But it wouldn't be a startup as we defined at the beginning of the conversation. So sometimes it's tough, but at the same time, then when the customer like comes and like buys your product, right, and then they tell you that they really appreciate what you are doing, right, like for them, that gives you again the hope, right? Because when someone like bought, right, there'll be another, right, one and another, right.
What have you learned about yourself during those 2+ years?
I think you will learn that you are much more resilient than you would think. And that you are able to kind of learn at a faster rate and like many more things, because I didn't almost like all my career I kind of like went into areas which I never imagined I would be like doing, and I wouldn't imagine that I would have the skills to be actually like doing that, but I somehow ended up, right, working in these areas, like building up the skills and the knowledge, and in the beginning you feel, okay, I'm an amateur, right, trying something, but like after a while you realize, all right, I already like, it looks like that we are the real deal, right, in here, because it looks like we understand it like better and deeper than the most like people, and in that moment they realize, all right, we are getting somewhere there.
And if you would look, a few years ahead, and Kilde was a successful startup, right? What do you think will the team and the customers and the company basically demand from you? Where do you need to move yourself during the time as a person, as a manager, as a founder, to be relevant, right, for the company as it grows?
Okay. Let me shift the question a bit. I had a conversation with a very successful founder in Vietnam, and was she the lady, and she was saying about the employees and the culture, right? Discussing, and she was saying, okay, you don't need to worry that much. At least when the company is not so large yet, about the culture and the leadership. As long as you as a founder represent these qualities, right, and you behave in a way you want the other to behave, right? And so just behave in the way how you want.
A role model.
Yeah, be a role model, and then people start behaving in a similar way, right? Obviously, when the company gonna grow larger, and we're gonna be, I wouldn't have a FaceTime contact with all the team members, then it will be more about influencing the managers, right? And perhaps we will need to write some of the rules or the values, right, down, right, and help the people to digest it and apply it further.
How did you finance Kilde so far as a startup?
It's a leading question. We have financed it in the beginning by our money, right? And we didn't want to,
right?
As founders, we didn't want to let
time, right?
Yeah, we were bootstrapping the business basically with our money, and we didn't want to let any investor in before, and any equity investor in before we had a license to do so, because it's a 0-1 kind of event, right? And we felt before we are allowed to do the business we were doing didn't make sense. It wasn't serious to ask other people to put money in. Once we get the license, then we realized, okay, now's the time, right? Now we see. And we also had the pipeline of the deals at that time. So we had both of the things, the license, the pipeline, and now needed to launch the platform, right? Start working. And it was the point we have kindly partnered with the Purple Ventures and several kind of high-profile angel investors from Singapore, which put the first pre-seed money into the company, and this pre-seed money lasted for a year. It was designed to last for a year, and after a year, we made another pre-seed round with another bunch of angel investors, and these times we focus on people who could help us to connect better with traditional financial infrastructure. That's something we have been lacking also in terms of the expertise a bit, but also in a connections and in a proper integration into the financial system. And once we got these people in, it became much more easier to speak with the investment banks, right, and others, so custodians, those kind of a traditional players, which will eventually help us in scaling the business further, right, into bigger funds, right, and bigger investors.
How do you see the fintech and these alternative lending worlds to evolve in coming years?
Okay, I think there's a big discussion about buy now, pay later, right now as we are shooting this, where we've seen valuation going down by 70%, right, of Affirm, Klarna, this kind of hallmark buy now, pay later lenders, and there's a little bit of doubt in the community. Does this a fintech lending model and the best fintech product this buy now, pay later really work, right? Wasn't it just a fad, maybe, right? There's a lot of questions around this.
And what's the fundament that it basically, the sentiment is that it's not so valuable as
I think it's the fundamental is because some of these companies and especially those which I have mentioned, they kind of follow this technology like a hype cycle and probably like grew too much together with the other technology stocks, right? And then eventually they followed the cycle of the market, right? But people started like adopting the economics, right? The unit economics of that model, which is a bit unfortunate. I think it's a bit of a misunderstanding because those are specifically buy now pay later are non-regulated companies which follow the financial reporting standard as any other company, and it's not very obvious like from that financial statements what the unit economics actually are. If they were reporting similar as the banks, right, then it would be much more apparent, right? So I can confirm from what we are actually seeing from like the data, right, that the unit economics, right, and the delinquencies, right, are under control, and it is absolutely independent on the stock price, right? And for different reasons, some of these companies might be in a loss because they are spending a lot of money on the marketing. But I still am of opinion, and it's an unpopular opinion at this time, that this is actually a market shifting product which will be replacing increasingly obsolete credit card business model. And we will see the penetration of the buy now pay later and the fintech lending continuing. Maybe these companies won't be so hyped it used to be. Maybe like they will not have a 1 billion valuations, right? And not going to be so many unicorns amongst them, but they will actually, like, the environment will sober up and there will be a stable, profitable, cash generating businesses as they should be, right? And that's perhaps what should have been in the beginning, right? So yeah, so I think, and also I am a firm believer that not much will change. Like in the traditional banking world, I don't expect that suddenly the banks will transform themselves into a savvy digital like banks, and suddenly they will completely like transform themselves. We've seen these attempts like every 10 years. There's some new topic, right? And then they try to reinvent themselves. I don't think that will happen. I think the traditional financial sector, the banks, I'm speaking about like retail banks, right? Commercial banks, they will be the piping, right? They will be the utility, right? Very useful player, like in the market, but probably in the emerging markets, this financial underserved like people, they probably served by the fintechs first, and then later we'll go to the banks. And we see a big trend in the Southeast Asia that the fintech players are actually purchasing the banks or getting a license as a bank as well. So they are kind of these things are merging. So a lot of interesting things are in the future on the horizon. I wouldn't be like that much worried about like immediate kind of like a trends right there, because the fintechs have a very solid, are solving a verified need, right? And they have a verified like a product which is solving this need, right? And in most cases, at least in the space I am in the lending space, there are positive unit economics, right? And the business is working.
Mm-hmm. And how do you see evolving the macroeconomics, right? We are recording this video early June 2022, and there are signs, just like you mentioned, right? The tech market, Nasdaq, right, going down. How do you see that in Southeast Asia, or globally? The direction, and how could that be impacting Kilde?
I think it would be actually could be a positive like for us, because we keep like telling that diversification of investments into the private investments into so-called alternatives is a very healthy thing to do. Like a different advisors are saying it should be between 10 to 20%. You should actually have a outside public markets, right? Because what happens in the public markets, like now what is happening, when the market goes down, kind of everything goes down. So if you look at, as of last week, we did a comparison of different asset classes, like a year to date, how they perform. Like only commodities, you are in plus. With gold, you are like more or less okay and around the same level. Everything else is down, right?
The growth assets, right?
Everything is down because everything is correlated, because it's a risk off suddenly, right? So, and people are shedding these assets, and every crisis, if I can call it a crisis, is a different one. Nowadays it's a supply crisis, right? Because China is not shipping as much goods as they supposed to be. We have an energy crisis in Europe because of the conflict in Ukraine, right? So this is a supply, right? It's a crisis. At the same time, the federal Fed has decided to lift the interest rates, and the other central banks around the world are expected to follow the suit, right? And this creates like the crash in the stock market, right? This creates a crash in the bond market, suddenly, and there is very little places to hide. Cash is not a good safe haven either, because the inflation, right? We have a double-digit inflation around the world, so where to go, right? But those investors who went into the private assets, right? They are shielded like from this, because the price of a private asset is not dependent on the buying and selling, right? The price of the private asset is typically driven by certain fundamentals, right? In our cases, fundamentals of like how much cash flow you are getting, right? Regularly, and when you will get the principal back, right? And if the risk of getting the principal back has increased or decreased, right? Plus the type of like debt, right? We are investing in consumer finance, SME lending debt. These are very, very highly diversified portfolios. There are tens of thousands of borrowers, right? So even in the very tough times, like the COVID in 2020, the lockdowns, right? It impacted the portfolios, but didn't impact the payouts to the investors. So it's a very resilient asset, like in that regard. So we believe that it will enlighten like more investors actually go into the alternative assets. And from the ethical perspective, what I like find appealing and why we invest into the consumer and SME lending asset, because in the end it's a productive investment. You put the money into work, right? You don't buy, I don't know, watches or a vintage car or a piece of art, right? Or God forbid, a farmland, right? For investment, because that's not productive. You are driving up prices of some asset, right? And sometimes it has a socially negative like impact. I would be a bit bold and call out the real estate like investment, especially in the residential real estate investment, a bit like ethically questionable. Obviously, depending how you invest, right? But you are basically driving up prices of a asset with a limited supply, which is actually intended for people to live in there, and suddenly the people cannot afford to buy it, right? Because they have been bought for a speculation, right? Let's go it this way. So alternative asset, yes, but like let's think about the ethical aspect, right, and the social responsible aspect of these investments.
You are about to do, in foreseeable future, another equity round, right, into Kilde. What qualities are you looking? You did talk about it a little bit, but let's say with institutional investors to come or strategic investors to come, what are the qualities you're looking at?
So we are looking at the two kinds of the investors. So we are looking into more like enlightened venture capital firms, right? which invest like beyond, I would say, kind of the hype. Now everybody needs to invest into buy now pay later. Now everybody needs to invest into security stock. Now like and so on, right? Because we kind of do our own business, we understand what we can achieve, but we are not a member of any of these hype group in a way, which is a good thing and bad thing at the same time, right? So that's one kind of the VC which will help like to grow, right? Confirm the valuation and help us to exit, right? Help the other investors to exit eventually. So there's one kind of investor, but the other kind of investor, we are speaking about institutions, is someone who has a synergy with our business, right? Somebody who has an investment business already, and they would like to have a better understanding of these assets we are generating, right? And they would like to invest into our equity, to stay in touch with us, right? To keep looking at the business, and again help us with a tighter integration to the rest of the financial system.
Knowing what it was like or is like to start a company, to start
a successful company, huh?
Yes. Would you do it again?
Yeah, I hope I will do it again. I hope that Kyle will be very successful and it will be there like for many years to come, right? But yeah, many things can happen. I might be asked like to give the reign to some professional CEO, right? Yes, I think with the entrepreneurship, there's almost like a no way back, right? In a sense, it's very difficult to go back like to the corporate job, right? Because the adrenaline, the excitement, right? The potential, right, is there, and that's why the best founders, right, are serial entrepreneurs. They do another startup and another one and another one.
And so, what would be the message to people who would actually consider start a fintech company from your end? What would you advise them?
Okay. So I should say something like "Go ahead and do it," right? It is expected, but it's. I think it's a good thing like to do when you are like a young, much younger than me, much younger than Ari, because you have not much like liabilities, right? So if you are in your 20s, right, and you are considering, okay, what should I go like start working for a big company or should I like do a startup? I think startup will give you much more experience, right? Maybe an even safer way, not funding your startup right away, but work for a startup first, a few years, and then do your own startup afterwards, right? Probably your chances of success will be much higher, right? And probably you will learn the skills you need, like more than you would be going to working in a corporate and then try to do a startup like from there.
Mm. At the same time, your experience was one of the key success factors that you got the license, right? If you were in your 20s, let's forget about it.
Yes, that's right. But our kind of like a business is specific, right? Because investment business, you are managing other people's money in the end, right? So it's a very responsible business. But at the same time, there are other startups like where the stakes are not like so high. Like you can do a technology business, right, or something which you can follow your passion, right, and your skills, like as well, and perhaps you'll be successful, right, like with that.
Thank you very much for your time to be with us today, and I would like to thank you for watching another episode of Purple Ventures Zoom video podcasts. I'm Jan Staněk from Purple Ventures. Please get in touch, and we'll be very happy if you subscribe to this channel if you are interested in topics of venture capital investing and startup journeys. Have a good day.